Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have Doug Noland back with me on this show. I think it's the second or probably the third time that Doug's been with us, not often enough in my view. Doug is currently portfolio manager for the tactical short strategy at McAlvany Wealth Management. And before that, Doug served as senior vice president and portfolio manager of Federated Equity Management Company, overseeing the Prudent Bear Fund and the Prudent Global Income Fund. Before that, Doug served actually was the portfolio manager for the Prudent Bear Fund while it was owned by David W. Tice and Associates. David Tice, of course, has been on this show a number of times as well, and he's someone we should get back sometime soon, I think. Anyway, Doug, he has quite a background as in the area of shorting the markets and various markets, and his background before that, his academic background in accounting, is an MBA from Indiana University. So we're really glad to have him with us again. Thanks for joining me again, Doug.
Well, thanks a lot for havhaving me, Jay. It's nice to be on the show today.
Yeah, it's really great to have you. I've admired your work, and I must say that at the McAlvany Wealth Management site, you provide a weekly page there that's very extensive, a weekly commentary of the markets, and anybody who really wants to drill down and understand a great deal of details and the logic behind what you're thinking, that's a good place to go. It's just you and David McAlvany started this tactical shorting business about 2 years ago. What did you see then that caused you to think it was the time? Because certainly we don't want to be short the market over 7 or 8 or 9 or 10 years. That can be disastrous, but something that you and David saw that caused you to believe that it's time to get back on the short side, or start at least looking at the short side.
Sure. I've been writing my credit bubble bulletin now for 20 years, and I'm convinced, and this is following cycles now I've been in the industry now for 30 years. I'm convinced, I think, David and I see things similarly. We're at the very late stage of what has really been a multi-decade bubble. And, back during the technology bubble, that's when I started writing the bulletin, and then that bubble burst, and I thought that was the big bubble. But then, in 2002, I had to change my tune, and I started warning about the mortgage finance bubble. Then when that bubble burst in 2008, I thought that was the bubble, but no, they reflated again. In 2009, I started warning about the unfolding global government finance bubble. I've called this the granddaddy of all bubbles. So, I think this is, just setting up for just a great opportunity on the short side. But David and I, what we really wanted to do is to create a product, a better product to try to help people preserve their wealth, to help hedge some market exposure, do things differently than some of the other short products. And we just, we think it's a great opportunity. We didn't think the market would go up another, 25, 30% after we started the product.
Right.
But that's just, we think it's just created a better opportunity for us going forward.
What are some of the differences between the tactical short strategy and some of the other shorting strategies that are out there?
Sure. And my experience on the short side goes back to 1990. I started with, basically short-only hedge funds. Back then, the model was, we did better research on individual companies than Wall Street would. These kind of large concentrated positions, and you wait for them to work. You had a lot of confidence in your analysis. Well, what happened is, the central banks kind of changed the game. The Fed changed the game, created a lot of liquidity, and the bubble started in the 1990s. And that really changed the risk reward of being short individual stocks. So I kind of learned that the hard way in the 1990s. So what I try to do is I try to be tactical with our short exposure. Today, for example, we're not looking to short individual company stocks because we think the risk reward of being short stocks is very high, or the risk is very high. So we don't want to be 100% short all the time like most short products. So we vary our short exposure, and importantly, we vary the composition of our short exposure. We'll use some options in sectors and try to stay out of trouble, try to avoid short squeezes, and then be opportunistic when the environment for shorting is more favorable.
Doug, do you see, you mentioned a multi-decade short, and of course if you go and look at at a chart of interest rates going back to 1981 or so, each of these bubbles ends up with lower rates of interest, such that we are now at zero bound, even negative bound in Europe. How much further can this thing go? Could this possibly be the last major bubble collapse before there's a new monetary regime of some kind, do you think?
Yes, and when the technology bubble burst, 2000, 2001, 2002, the policymakers used mortgage credit to reflate the system and encourage mortgage lending and hedge fund leveraging and mortgage-backed securities and derivatives. They were encouraging all of this to help the system reflate. Well, that just created the mortgage finance bubble. Then when that bubble burst, then they came with central bank credit and sovereign debt. That's why I refer to it as the global government finance bubble. So this is kind of the end of the line as far as there's, once you get to the heart of the foundation of finance, sovereign debt and central bank credit, there's no place to go afterwards to reflate from there. So we are at the final stage, although, they can use QE to whatever extent they decide to. And, they're already talking, the ECB, not many months ago ended their QE program, and they're already talking about starting it up again. So it is the end of the cycle, but central bankers obviously are ready to, do whatever it takes as far as they're concerned, right, to keep the game going. It's just a very dangerous game.
Yeah, I know Jim Rickards, who we've had on the show, talks about the last place to go would be the IMF, and that they would be the only bank, the only entity that would be ready and available and able to bail out the banks, the central banks around the world. And that would seem to me to suggest perhaps a new monetary regime of some kind that might be in the making. And I don't know if you have any thoughts about that.
Well, I think going forward, it's going to be very difficult for nations to come to a consensus as far as to how to deal with these problems, right? That's one thing with the 2008 crisis, right? Central bankers kind of, they got together, they had one strategy, the governments were all for this concerted effort to reflate. It's not going to be so easy next time. I also think the scope of the problem here is so much larger than 08. If you think back to 08, the first QE program, the first $1 trillion, it basically didn't even add any liquidity to the system. It just accommodated shifting leverage from hedge funds and some of the banks and Wall Street firms to the Fed's balance sheet.
Wow.
Well, I think the amount of leverage, speculative leverage globally is so much beyond 2008. So we could get into a situation where the first few trillion of QE just go to accommodate, deleveraging by the speculator community. So I think the scope of the problem is much beyond what the IMF can deal with. We'll see how it plays out, but I don't look at the IMF as being any savior for the global financial system.
Interesting. Well, it just leaves one to wonder how things will shake out when that fateful day arrives. I guess we have to. Well, what would you say to people then? What do we need to do? I want to ask you more about shorting, but looking at the situation now, I mean, not everybody can short. I suppose a lot of people can short through a fund, if people of modest means, but just in general, I guess people definitely need to stay out of debt. They definitely need to have cash or gold or something that will retain its value. Because do you see, Doug, the prospects then of a hyperinflation at some point in time? Because of what we've seen so far with these bubble collapses, is the opposite. We see massive collapse of markets, which leads, at least for a short period of time, to collapsing prices before they start to reflate them again. But how do you see this thing working out overall in the end?
Yeah, and there's a lot of factors here that we're just going to have to follow over time to try to stay on top of this. Yeah. I would argue that we've had hyperinflation. We've just had it in
financial assets,
global bond prices, a lot of stock prices. So we've seen the hyperinflation. The problem is central bankers, right? They're trying to inflate this general price level, and they believe if they inflate this general price level, then the debt excess doesn't matter because you can always raise a general price level and devalue your debt. Asset bubbles don't matter as much because you can always inflate corporate earnings and the price level to make asset prices seem more reasonable. So they're in a real pickle right now because they do aggressive monetary stimulus and it leads to bigger bubbles, higher asset prices, and the general price level barely budges, right? So it's another indicator that we're late in the game. And Jay, I'll also throw out, because some of this might sound extreme when we're talking about that central banks may need a few trillion of QE just to sustain the system. Well, I think that is exactly what global safe haven bonds are telling you. That's what the German Bund at negative 40 basis points is telling you, right? The Swiss bond at negative 78 basis points.
Wow.
These bond markets are telling you that the central banks will be out aggressively with more QE. So I think there's some reasonableness to that view, right? They see the same. A lot of sophisticated market operators see the same fragilities that we're talking about right now. And so it's not some crazy idea. It's something that I believe is already being discounted in the bond market. Stocks play a different game, right? Why worry about the long term when you can make 35% year to date in the semiconductor index, right? It's a short-term trading focus. And this divergence is not unlike what we saw back in late, 2007 when U.S. equities, even in the face of the eruption in subprime, went to all-time highs. Meanwhile, the bond market in late 2007 was saying, wait, something's not right. Bond yields were collapsing in anticipation of aggressive monetary stimulus.
Doug, where do you see the greatest shorting opportunities right now? I mean, what are you looking at to profit from, or does that change day by day and week by week?
Well, right now, the focus is just being defensive. We're not out there. We're just trying to provide a hedge without getting our heads taken off, right?
I see.
And I also want to say that I strongly encourage individual investors to avoid shorting because they can get caught in not appreciating the risk. Stocks can double or triple on you. And I think if you're going to be short, find a professional, some type, a fund or something. Just avoid it yourself because it's really tough. Yeah. So we're waiting to see a tightening of financial conditions. There's a mosaic of indicators that we follow pretty closely. But there are opportunities throughout the market. Some of the greatest excesses are even in defensive areas where people think they're buying safe stocks. Obviously, the technology area, I think the bubble in technology goes significantly beyond 1999. So there is no shortage of opportunities on the short side, but on the short side, timing is so critical. And there are points in the market where risk control, risk management, that is the focus because things can go a little nuts. Things can go crazy at the end of the cycle. We saw it, if you remember back, Jay, that technology stocks did their parabolic in the first quarter of 2000. Even in the face of deteriorating fundamentals, they did that final melt up before the collapse commenced. So it's not unusual to see what we're seeing in the marketplace where it turns really speculative right before payday on the short side.
Yeah, on June 12th, I'm just reading a quote from you. You said, "I don't believe the primary impetus behind the global central swing towards additional stimulus is economic. Indeed, I see Powell, Draghi, Carney, Kuroda, and the like confirming the acute global financial fragilities thesis. So you think these guys, these central bankers, really are scared of what they see, and that we're likely, as I understand, to see a bit of a rate cut tomorrow, a quarter percent perhaps. But do you think the central bankers are really frightened with what they see?
I absolutely believe that. In December, I think it was December 19th, the FOMC meeting, they raised rates, and the belief was, that the economy was sound, the markets were sound, and about 2 weeks later, they abruptly reversed that with the Powell U-turn, and that's because the markets were unwinding rapidly at the end of December and the first few days of January. It was, for me, it was amazing how quickly you could see things unwind, and you could tell that there was a risk off and deleveraging and problems unfolding in the derivatives markets. So yeah, the global financial system is an accident in the making. China is an accident, one of the greatest bubbles in history. This whole proliferation of ETFs and different derivatives that, people think they're liquid when in fact they hold securities that in a difficult market environment, it would be very, difficult for them to sell them. So yeah, I think central bankers, I don't think they probably appreciate the degree of fragility, but they have a pretty good sense that, they've got a difficult job to try to keep these markets stable.
All right, with just about 2 minutes left, Doug, I'd like to get back to this issue of inflation, deflation. I know as an Austrian thinker, you see inflation as the creation of money, excess money supply, or money that's created out of nothing. Money is, that when it's created, that is inflationary, right? And so you see the inflation going to the financial assets. So do you see then an implosion of financial asset values and not necessarily an increase in commodity prices or consumer goods, or what is your take? Where do you think we're going to go? And the reason I ask is because, a lot of people are buying bonds as treasuries as a safe haven, treasuries and gold. Of the two, is there a place in your portfolio to be long U.S. treasuries? Let's say long-term treasuries, not short-term treasuries.
I would not own long-term treasuries. I know the market disagrees with me right now. I don't like to own a financial asset where that there's endless, huge supply coming. Yeah. Right? Yeah. It's a market with huge price distortions. I think the Fed's balance sheet goes to $10 trillion the next cycle. In that environment, I want to own hard assets. I want to be light of financial assets. And that view could change as we see this unfold. But I think the Fed's not going to have any choice but to aggressively expand its balance sheet. And at some point, there'll be a crisis of confidence in financial assets. I fear. I hope I'm wrong. I hope I'm wrong.
I hope you're wrong. Everybody in their right mind hopes you're wrong. But, Doug, it's because of of what we see and the policies, the Keynesian economic policies, endless amounts of credit, debt-based money that has caused us to go to gold and silver and other hard assets. So with just a minute left here, or 30 seconds or so, we get a rate cut tomorrow, and if so, what will it be, 25 basis points or 50?
Well, I think 50 basis points would be reckless. So I think 25 is not prudent, but I'm assuming 25, and it'll be interesting to see if the Fed tries to talk the market's expectations down, to try to say, wait, we're data dependent here. We're not necessarily starting a rate cut cycle because the market's already built in multiple rate cuts. Yeah. And the data does not support that. So if the Fed wants to be data dependent, they're going to have to try to convince the markets to not be, to discount so many cuts. Right.
Well, once that stock market starts to tank, though, we'll see if Chairman Powell changes his language. We'll see what happens. But I want to thank you so much, Doug, for being with us. It's really a pleasure having you with us. Your insights are very valuable. And folks, you should go to the McAlvany website to tune in to all and take advantage of all that Doug provides, because he provides a wealth of information, and it's free, actually. So I would suggest strongly that my listeners go there. So thanks again, Doug, for being with us.